Welcome back to the stock portfolio update videos. Currently, my two stock portfolios are sitting at over $83,000. That's made up of the $48,000 in my stake portfolio and the nearly $35,000 in my Vanguard portfolio. Overall, it's been a recently strong past quarter for my stock portfolios, and today I'm going to be doing an update going through some of the earnings that recently happened and how they've affected my portfolio, what I plan to do about this news, and just my overall general thoughts. So today's going to be a bit of a longer video as I go through many of my holdings which actually released earnings, such as Apple, Amazon, Google, and Microsoft. So many of the tech giants all released their earnings, but I'll start with just doing a quick portfolio overview of how things are looking going into this week. So overall, my stake portfolio did trade down a little bit. I was up around 34% at one point, and it's traded down to 32 as there was a little bit of a pullback in the markets. And if we have a look at VOO, which just tracks the S&P, you can see it's down roughly 2% this week. So this is by far my biggest holding. So whenever there's any fluctuations in VOO or the S&P, my portfolio feels it quite a bit. And with many of my holdings being some of the major positions in the S&P, I'm quite vulnerable to these fluctuations. So overall, no positions have changed. I did actually just get a small dividend from JP Morgan, something like $6, and wasn't too bad. JP Morgan is a position I'm looking at maybe exiting going forward, but more on that in future videos. It's had a very good year, up 56%. I locked in some gains earlier, and again, I'm up nearly 73% in JP Morgan, so it's been a very strong position for me. Going through my Vanguard portfolio, you can see nothing has also changed as well. I invest in the exact same two holdings. Only difference is I have grown it again, so I'm now sitting at $34,693 in total value. So getting really close to that $35,000 mark that I've been patiently waiting for. And my Vanguard portfolio with my stake portfolio is getting close to that $85,000 mark. Hopefully, when the Australian dollar gets a bit stronger, I can put some more money into my stake portfolio and I can get this closer to $50,000, because we were in the $49,000 range, but again, market pulled back, so lost a bit of equity there. The first earnings I wanted to go through was Alphabet. So having a quick look at how the stock has been performing, if you're an investor in Alphabet, you can see it's had a decent return this year, up 32%, a bit less than the S&P, but it's had a lot of volatility up and down. Going into the earnings, it was trading up and then had a very strong bounce with the earnings. I believe it was around 5 or so percent, 5-6%, and it's kind of cooled off. If you have a look at this last at back end of the week, the stock's kind of pulled back down again. From it previously was close to 180. It's now pulled back to around 170. I have around 10 shares in Google, and my total equity is around $1,700 with an average share price of around 136. So up around 25%, and this isn't a position that I've been holding for that long. It's a position I actually invested in after I sold some of my other ones like JP Morgan, and it's done quite good for me in this short amount of time. And its earnings were not disappointing either. Alphabet shares rise on earnings beats boosted by cloud revenue. So if you've been invested in Google, you would have heard of Google Cloud, and that was a very strong result this quarter. The company reported a blowout cloud revenue of $11.35 billion, up nearly 35% from the $8.41 billion a year ago. Alphabet reported stronger than expected earnings, and Alphabet's chief financial officer said the company plans to build on existing cost-cutting efforts using AI to streamline workflow and manage headcount, the company's physical footprint. So Google's parent company Alphabet reported third quarter earnings beating on their top and bottom lines, with strong revenue growth from the company's cloud unit. The company's shares rose about 5% on Wednesday, and its EPS was $2.12 versus the $1.85 expected, which is a massive beat. And its revenue was $88.27 billion versus the $86.3 billion expected. Other numbers included YouTube's advertising revenue of $8.92 billion versus the $8.89 billion, cloud revenue of 11.35 billion versus the 10.88 billion, and the traffic acquisition cost of 13.72 billion versus the 13.53 billion. So Alphabet's revenue grew 15% year over year, which is stronger than the same quarter last year, and the company reported a blowout cloud revenue of 11.35 billion, up nearly 35% from the 8.41 billion a year ago. The company attributed its strong cloud results in the artificial intelligence offerings, which included subscriptions for enterprise customers. Alphabet's CEO opened his call with investors saying the company's full stack of AI products is now operating at a scale and being used by Google's billions of users and creating a virtuous cycle. The searches company's quarter kicked off a week of earnings, such as Meta, Microsoft, and Apple and Amazon, which I'll also go through, and Alphabet's net income increased to 26.3 billion, or 2.12 per share. Google's search business generated $49.4 billion in revenue. That was up 12.3% from a year ago, and the search business remains the largest contributor to revenue growth for the company, says the Alphabet's chief financial officer. This is another big thing that they wanted to highlight that a lot of people are speaking about currently, and that is their cost-cutting methods. As it says here, turning to AI for more cost-cutting. Alphabet plans to build on existing cost-cutting efforts around using AI to streamline workflow, manage headcount, and the company's physical footprint. I plan to build on these efforts, but also evaluate where we might be able to accelerate work and where we need to pivot to free up capital for more attractive opportunities, said the CFO, who joined the company in June after 23 years at Eli Lilly. Alphabet reported advertising revenue of $65.85 billion. That was up from the $59.65 billion a year ago, showing that Google's advertising business continues to grow through a slower pace than its second quarter. YouTube ad revenue just beat analyst expectations, showing better growth than last quarter. The Google-owned company faced increasing pressure from other advertising options such as Netflix, TikTok, and Amazon. AI is improving YouTube recommendations, Chief Business Officer said on the call. The company's AI language models, Gemini, has given YouTube the ability to recommend more relevant, fresher, and personalized content to the viewer. Google's Workspace, the company's collection of cloud computing and productivity suite, saw strong growth during the third quarter. And overall, other bets, which included the company's life science unit, Verily, and self-driving unit Waymo, reported a revenue of $388 million in the third quarter, up from $297 million a year ago. It was a really positive time for Google investors, and all this kind of did was kind of assure people who kind of did look to buy the dip when Alphabet was trading a little bit sideways, and it did drop off here. It was quite an attractive buy for people who I was speaking to. Company was still strong, but there was lots of worries if AI was going to affect its search monopoly, but it doesn't seem to be the case, with searches still being up and Google still printing money, and they're still a player in the AI space with their language model Gemini, which I've used myself. It's all right. I don't think it's as good as ChatGPT. I don't think it's as good as Llama either, but it does do the job, especially if you're just looking for basic uses. I think Gemini, again, does exactly what it needs to do. And with all the data it has out there to build its model on, I think it's only going to get better and better for everyday users. Overall, the next one I wanted to highlight was actually Microsoft. So whilst Alphabet had a strong quarter, Microsoft dipped on weak guidance around it beating on its earnings. So it did still have good earnings, but it hasn't satisfied investors. And Microsoft, you can see, is actually my biggest individual stock holding, and it's sitting at $5,577 US in total equity, which is around 13.5 shares. I'm up around 30%, or $1,300, and my average share price is around 314. So if you have a look at the last 6 months, it's kind of flat. It's pretty much flat, 0.91. And it did climb up all the way up to around 400 and give or take $70, and it's traded all the way down now to 410. So I watched a YouTube video of another content creator here on YouTube going through why he believes Microsoft was still expensive even after its sell-off, and he did make some valid points about how expensive it is trading forward with its PE ratio, and how big the company's got. It's going to be hard to continue to grow into that price to earnings ratio. Again, you can do your own research whether you think it's a good company to invest in or not, and whether you think this price is a good price to buy in it. But again, it is my biggest holding. It's a company I was very bullish on for a few years, and I used a lot of this time in 2022 when it was down to buy in, and I've kind of reaped the rewards. The reason why my average share price is a little bit higher than what it could be was because I kept dollar cost averaging in, as I believe Microsoft and the likes of Costco have two of the best business models. But like Costco, I think the stock did get a bit expensive, which is why many investors are saying, even with the recent pullback, it maybe has to pull back a bit more before they think of deploying some capital. But going through the earnings, Microsoft's revenue grew 16% in the fiscal first quarter, faster than analysts had anticipated. Revenue from Azure and other cloud services was up 33%, surpassing estimates, and guidance for the revenue growth fell short of expectations. Microsoft reported an earnings and revenue beat for the fiscal first quarter on Wednesday, but the stock slid 4% in extended trading after the company's forecast called for slower growth than expected. Having a look at how it performed, its earnings per share was $3.30 versus the $3.10 expected, and its revenue was $65.59 billion versus the $64.51 billion expected. Revenue increased 16% year over year in the quarter, which ended September the 30th, according to a statement, and net income rose 11% to $24.67 billion from the $22.29 billion a year ago. For the current quarter, Microsoft called revenue in the range of $68.1 billion to $69.1 billion. That implies 10.6% growth in the middle of the range, which analysts were looking for around $69.83 billion, which is a little bit higher than what Microsoft has announced. Outside suppliers are late in delivering data center infrastructure to Microsoft, meaning the company won't be able to meet its demand for the fiscal second quarter. I feel pretty good that going into the second half of even this fiscal year, that some of the supply demand will match up, is what the CEO said on the conference call. In August, Microsoft said it would revise the reporting of business segments to reflect its management approach. Mobility and security services, along with some Windows revenue, are now part of the productivity and business process units, which includes Office software. Revenue from productivity and business processes rose 12% to $28.32 billion in the quarter, topping the $27.9 billion consensus amongst analysts. It's 38% higher than the $20.45 billion midpoint of the forecast that management gave in July, because the actual totals for the changes. Investors received a clear picture of cloud computing consumption at Microsoft for the first time. The Azure and other cloud services revenue growth metric excludes mobility and security and Power BI data analytics. Sales, Azure rose for the quarter came 33% or 34% at constant currency, with 12 points coming from artificial intelligence services. Overall, when you compare it to the Google report, it did have a strong results in terms of its earnings, but like it says, that going forward, that forward approach didn't seem to be as positive as what analysts were expecting. So even with all these beats, it's still traded down, just showing you how volatile the stock market is currently with how much it did trade up recently. And when you have a look at the last year for Microsoft, it's only up 16%. When you compare that to the S&P's 40% nearly year, Google 32%, many other tech giants up 30% and over. Microsoft investors have not had the best year so far with this stock, and potentially this is a time to buy in if you believe this is it's been discounted now, but you have to do your own research, and it's definitely something I'm going to look into with the likes of Amazon and some other players with where I want to put my money as I aim to climb towards that $100,000 mark. But it hasn't changed my outlook on Microsoft. I still believe in the company long term, and I don't think I'm going to be selling out any positions, especially now when it's down. Just because things are down, it means you're more than likely going to sell out at a bad time. So I'm just going to hold on my eggs at the moment and just keep a long-term outlook. Having a look at Meta, another one of the big tech giants, it missed on its user growth and warns of 2025 jump in AI spending. Meta reported a weaker than expected user numbers in its third quarter earnings report on Wednesday. The company reported 3.29 billion daily active users for its third quarter, which is up 5% year over year, but came in below analyst expectations. The company said it expects capital expenditure to continue significantly in 2025. Meta reported a weaker than expected user numbers and warned of a significant acceleration in infrastructure expense in 2025 in its third quarter reports on Wednesday. Its earnings per share was $6.03 versus the $5.25 expected, and its revenue was $40.59 billion versus the $40.29 billion expected. Sales in the third quarter jumped 19% year over year, while net income grew 35% to $15.7 billion from the $11.6 billion a year earlier. That represents Meta's lowest year-over-year growth for net income since the second quarter of 2023. The company reported 3.29 billion daily active people for its third quarter, and that was up 5% year over year, but came in below analyst expectations. Meta also raised capital expenditures guidance for 2024 fiscal year between 38 and 40 billion, up from the 37 to 40 billion previously. Additionally, the company said it expects capital expenditures to continue to grow significantly in 2025 due to acceleration in infrastructure expenses. Our AI investments continue to require serious infrastructure, and I expect to continue investing significantly here too, is what the Meta CEO Mark Zuckerberg said on Wednesday. Zuckerberg has pointed to the company's massive investments in artificial intelligence, which includes spending billions of dollars on NVIDIA's popular graphic processing units, as helping improve the company's core online ad business in the aftermath of the Apple 2021 iOS privacy update. The company has been improving upon and building more data centers to help provide the technology infrastructure needed for its AI strategy. More than 1 million advertisers use Meta's generative AI advertising tools, is what Mark Zuckerberg said, and Meta expects a total expense for the fiscal 2024 to be in the range between $96 to $98 billion. Overall, Meta is actually a stock I used to own long time ago, and I actually sold out of it at a very bad time. So it was a really big lesson for myself to kind of understand what I'm investing in and not sell at the worst time ever, because obviously you do get some benefits in terms of maybe you can use that negative sale for other things, but when you have a look at its last year, it's up 80%, and even with this recent news, the stock is only down 2.3%, and in the month 1.35. But if you have a look at the last 6 months, again, up 25%, and the last year 80%. Having a bit more of a long-term outlook, if you were someone who was smart enough to buy in 2022, this is when they were spending all that money on the metaverse, and it got a real negative sentiment amongst investors. It's had an amazing run up since, and I was dumb enough to actually sell around this point, and I think I lost around 500 USD, which at the time was a decent amount of money in my portfolio, but it did teach me a good lesson about being confident in your investments and understanding the positions that you're in. So when there are market downturns, you can double down and invest more and kind of make the most out of the buying the dip, as people say. But it wasn't something I did, and I lost a lot of money on it. So now I'm trying to narrow my portfolio down to some stocks I really believe in. And again, I'll be doing another review at the end of the year, just so I kind of have a full understanding of what I'm investing in and I don't sell at a bad time. But I think Meta investors aren't too worried about an increase in CapEx. There's always going to be an increase in capital expenditure when there's a boom like this, and these data centers aren't coming cheap, and either is these processors from NVIDIA. So if Meta wants to be a leader player in the space, then they're going to have to obviously invest money, and they're putting a lot of time into that Llama 3, or I think there's a Llama 3.5 or something like that came out, but it's quite good. I used to use it a lot. Again, I don't think it's on the level of ChatGPT, but it is a good language model for just day-to-day use. So do your own investments and see if you want to invest in Meta at this time, but it has had a very big run up in this last year. The next position was actually a position I used to own and recently sold out of, and that is McDonald's. So if you've seen, McDonald's has been in the news around health reasons. I think it was a E. coli breakout that they had. But this was a position I held for a little bit, and you can see it's kind of tanked in the last month, had a bit of a rough drop. And if you go the last week, you can see it a bit better. It's kind of traded down, and it had this big drop off here from around $315 a share down to $298. So I did invest in McDonald's back in the day. I still think it's a great company, but I thought I could probably make a bit more money elsewhere. When you look at the last year, it's up around 10%, but that's with a big dip in the middle and a lot of volatility. In the last 5 years, it's only up 52%, so it's not been the best returning stock. And having a quick look at the earnings, it's McDonald's reverses US same-store sales decline in the third quarter, but the E. coli fallout looms. McDonald's third quarter earnings and revenue topped its estimates. Its US restaurants reversed last quarter's same-store sales decline. However, there's still worries about its recent breakouts. McDonald's on Tuesday reported quarterly earnings and revenue that beat analyst expectations, and its US restaurants reversed last quarter's same-store sales decline. However, investors are worried about another dent in the US sales fueled by the recent E. coli breakouts around 13 states linked to McDonald's Quarter Pounder burgers. As of Friday, 75 health cases have been tied to the outbreak, including one death of an older adult. Daily sales and traffic turned negative immediately after McDonald's was linked to the breakout. Their CFO said Tuesday that the company's earnings call. Still, the company is expecting the situation to have a material impact on its business. Health authorities have honed in on the burgers' silvered onions as the likely source, and McDonald's has suspended its relationship with the supplier. Quarter Pounder burgers will return to its affected restaurants on a rolling basis this week. So, a bit of a weird one. I live in Australia. I haven't heard much about this here, but I know this was happening obviously in the US. Again, it beat out on its earnings, $3.23 versus the $3.20, and it beat out on its revenue but with a restaurant business, you always run that risk of health. It's the same way with a tech business. If something goes down like CrowdStrike, there's always a risk of something going to happen, and it's just unfortunate that this happened right for them at their earnings call when they did have some beats on their returns. So net sales rose 3%, and excluding certain items, the fast food giant earned around $3.32 a share, but it's not been the best time recently for McDonald's. And I'm not saying that's the reason why I exited the position, but when I compare it to other positions in my portfolio where I think I can get gains, positions like Costco, Amazon, Google, I think they can provide outsized returns compared to McDonald's. I still think in 5 years, 10 years time, McDonald's is still going to be a money printing company. You're still going to be able to get good dividends, good capital growth. And I think if you're a long-term investor, maybe it's a good investment for you. But I decided to take my gains in McDonald's and reallocate the funds elsewhere. But it's still a stock I keep my eyes on and trade, as it's a company that touches everywhere across the world. No matter where you travel to, whether I've been to Asia, Europe, anywhere, there's always a McDonald's nearby. So it's always good to keep your eyes on McDonald's and how it's trading. Lastly, or two more to go, two of my top positions here you can see, and we're going to start with Apple, which also had its recent announcements, and it has been on a tear the last 5 years, up 242%, and in the last year it's up 26%. It's had a really good run up in the last 6 months, up 21%, after it had some downturns over people worried about the China side of the business and the growth. Apple does what Apple does, and it just continued to perform. I own around 18 shares, which is around $4,085 in equity, and I'm up around 56% at $142 a share. So again, my share price was previously lower, but I dollar cost averaged like many of my stocks, and it did rise, but I'm still had a very good return at 56% with dollar cost averaging. Having a look at what they're saying, so Apple's sales rise 6%, company seeing early iPhone 6 demand. Apple's fiscal fourth quarter results beat Wall Street expectations for revenue and earnings per share, and the net income slumped after the company paid a one-time charge as part of its tax decision in Europe. iPhone sales and overall sales rose both 6%, and sales of iPhone 15 were stronger than 14 in the year-ago quarter, and the 16 was stronger than the 15, as the CEO of Apple has announced, Tim Cook. Having a quick look at the breakdown, you can see the EPS was 164 adjusted versus the 160. You can see revenue 94.93 billion versus the 94.58 billion, and iPhone revenue up. Mac revenue was just below, and iPad revenue was also down. So other products again down, most of the services down, and gross margin was just above. So iPhone seems to be the only one that was beating in comparison to some of the other products. Overall, iPhone revenue grew 6% in the first sign of how the iPhone 16 is faring in the market. Apple's newest device came out on September 20th, giving Apple about a week of new product sales in the quarter. It's still Apple's most important product, accounting for nearly 49% of the company's overall sales. Sales of the iPhone 15 were stronger than the 14 a year ago quarter, and the 16 was stronger than the 15 is what they're highlighting. Cook said the company was looking forward to Apple's Intelligence, the AI system for iPhones, Macs, and started to roll that out as part of the iOS 18.1 update. We're getting great feedback from customers and developers, already getting an early start, and you can see that's one of the big things that they're going to be going on about. Overall, Apple is one of the biggest stakeholders no matter where you are, whether it's in your investment plans or whether you're directly investing in it. Everyone seems to have some exposure to Apple, whether you're a stakeholder with an iPhone or someone who works for Apple. It's just such a big company worldwide, and its revenue rose around 2% to the full fiscal year to $391 billion. So it is such a big company, and it's one of my oldest holdings. It was my first ever stock I bought, and it has got a lot of flack recently over the last year or so about the iPhone releases every year. They did mention they might change it to every 2 years, or what the case was. I didn't quite follow, but I personally have an iPhone 15. Seems to work quite well. I previously had an 11, so I kind of skip a few years, and it seems to work for me. I think it's quite consensus around many people. There's not as much of a buzz anymore around when a new iPhone gets released, because it is hard to keep improving, which is something that shareholders worry about. Like, there's a guy I follow called Joseph Carlson. I think he was selling out of some of his Apple position, but it's something I'm still holding on to. Again, like I said with some of my others, I think if I was to leave this portfolio for 5, 10, 15 years, Apple would still be where it is, finding new ways to make money, generating value for shareholders, and I still think of it as a long-term great blue chip play for my stock portfolio personally. Whilst I think there might be some issues with some of their sales going forward and growth prospects, I still think there's hope for the company. And when I think about where else I could put the money, at the moment it seems like everything's expensive. So when it comes to what quality companies I believe in, I still have faith in Apple, and that's why it's still one of my holdings at $4,000 a share. I mean, at $4,000 in equity. Lastly, I wanted to go through Amazon. So Amazon is one of my more recently growing holdings. So I have got around $1,647 in Amazon, and that's around 8.3 shares. And I'm up around 23% in the short time that I've been kind of growing this position. You can see my average share price is around $160 a share, and the share's trading basically at $200 a share now. So it's been quite good. The only thing is, I wish I could have grown the position more. When you look at its recent earnings, Amazon shares pop on earnings beat and cloud growth, just like with Google. Amazon shares surged in extended trading after the company reported a better than expected earnings and revenue. The company's cloud and advertising unit showed strong growth. Its earnings was 1.43 versus the 1.14 per share expected, and its revenue was 158 billion versus the 157 billion expected. Amazon Web Services came to 27.4 billion versus the 27.5 billion expected, so just missing out. And advertising was 14.3 versus the 14.3, so right on par. In cloud, Amazon Web Services revenue was a hair below consensus estimates, but it's growing faster than the same period last year. Sales grew 19% during the quarter, and compared to the year ago when the sales accelerated by 12%, the company was navigating slower growth in cloud business last year as customers trimmed their budget due to heightened economic concerns. Amazon's AWS is still growing at a slower rate than its top challengers. Revenue from Azure and other cloud services at Microsoft came in at 33%, and Alphabet's Google Cloud revenue increased to 35%. So Amazon's capital expenditure surged 81% year over year from $12.48 billion to $22. So this is a similar story to what happened at Meta, as it continues to invest in data centers and equipments like NVIDIA's GPUs to power its artificial intelligence products. Amazon has launched several AI products in its cloud and e-commerce business, and is also expected to announce a new version of Alexa's voice assistant powered by generative AI. So, similar to what's happening across all the big tech companies, you can see it's pretty consensus where an increase in capex as they try to build out this infrastructure to compete in AI, but a lot of cloud growth, as that seems to be a position where a lot of these businesses are going to be going forward. So again, as someone who's been growing their position in Amazon, the only thing I wish was that I grew it a bit bigger and that I could have put more money into it. Advertising was another bright spot for the report. Sales in the unit expanded 90% year over year and to $14.3 billion during the quarter, outpacing growth in Amazon's core retail business. Amazon and Apple also reported quarterly results together, as we just went through, and as a Amazon and Apple investor, I think these are two companies I plan on holding a bit more long term. And if you have a look at last 5 years of Amazon, it had this dip again in 2022. This is when I was trying to grow my positions around many stocks, but it wasn't when I was putting enough money into Amazon. I believe I actually sold some of my Amazon back around here in 2022. Like Meta, I kick myself for doing it because I missed out on a lot of gains because I wasn't 100% sure about my investments. But I tried to reverse this and I put some money in again as I believed in the company, did a bit more research, and I'm up 23%. And hopefully I can grow that equity to around $2,000. Having a quick look at my Vanguard portfolio as well, you can see not much has changed, but I am getting closer to that $35,000 mark. And the goal is to get this to $50,000 next year as I slowly grow my ETFs. And I kind of keep that long-term outlook of trying to keep diversified, as that's the reason why I have my stake portfolio, which is a bit more growth orientated, and my Vanguard is a bit more long-term. Having a look at the Excel, you can see this is how both portfolios are kind of weighted. VOO still takes up 52% of my American, and you can see that VGS and VLC take up 42 and 58% respectively. It was a very strong month for me in terms of my stake and Vanguard portfolios. You can see my stake portfolio was up around give or take $3,000, and my Vanguard portfolio was also up close to that $4,000 mark. So very good month. As you can see on the graph, things are just going up, and hopefully I can get to $85,000 to $90,000 before the end of the year. Also wasn't a bad month for dividends. I got $49.70 USD in my stake portfolio as my VOO paid out, and so did JP Morgan. And then in my Vanguard portfolio, I got my quarterly dividends. So when you see on these different graphs, you can see how it's slowly growing year on year. And again, I'm not a dividend investor, but I'll take the extra dividends in my pocket. This was just an update, kind of going through some earnings of my holdings. I'm getting closer to 900 subscribers, so I'll keep my eye on that, and I just plan to keep consistently uploading these videos, and then hopefully I can get on this road to $100,000, and I can keep tracking these videos to show my progress. Cheers.